Charge going up, fire in the hole, go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this lesson, we're going to talk about market structure, the framework that shows you exactly what the market is doing and where it's likely to go next. Market structure is the language of price action. It's how professional traders read the flow of the market without relying on indicators. Once you can recognize structure, you can identify high probability trade setups and avoid confusion. The market only moves in two main environments, trending or ranging. Everything else is a variation of these two. Let's start with a trend. A trend is simply a series of directional moves that show momentum either up or down. In an uptrend, the market forms a pattern of higher highs and higher lows. Buyers are in control, and each pullback finds support higher than the last. For example, if NQ rallies from 15,200 to 15,400, pulls back to 15,300, then pushes to 15,600. That's a clear uptrend. Price keeps making new highs, and every dip finds demand. In a downtrend, the opposite happens. The market forms lower highs and lower lows. Sellers are dominant, and each rally gets sold earlier than the previous one. Imagine YM falling from 38,200 to 38,000, bouncing to 38,100, then dropping to 37,800. That's a textbook downtrend. Each recovery fails lower than before, confirming bearish structure. Between trends, the market often consolidates into a range. A range happens when price moves sideways between two key levels, support and resistance. Buyers step in at the bottom, sellers step in at the top, and price bounces back and forth like a pendulum. Ranges usually form when the market is pausing to gather orders for its next move. Breakouts from these ranges often lead to the next trend. Understanding whether the market is trending or ranging helps you decide which strategy to use. In a trend, you trade with momentum, buying pullbacks and uptrends or selling rallies and downtrends. In a range, you trade between levels, buying near support, selling near resistance, and staying patient until price breaks out. The key is not to guess direction, but to read behavior. Here's how to identify structure quickly. Zoom out to the higher time frame, 1 hour, 4 hour, or daily. Mark the most recent swing highs and swing lows. Ask yourself, are highs and lows rising, falling, or staying flat? If they're rising, it's an uptrend. If they're falling, it's a downtrend. If they're flat, you're in a range. Remember, structure starts on the higher time frame and trickles down. A 5-minute chart may look choppy, but the 1 hour chart might reveal a clean uptrend. Always trade in the direction of the dominant structure. Market structure is also dynamic. It evolves over time as new highs and lows form. What used to be resistance can become support after a breakout. This is called a role reversal, and it's one of the strongest confirmations you can use in trading. Here's a tip used by professionals. Structure resets after every significant break in highs or lows. When price breaks the last swing high in a downtrend, the structure shifts. That's your cue that momentum is changing hands. Understanding market structure gives you clarity. It stops you from fighting the trend, chasing price, or entering trades blindly. Once you can read structure, you'll know exactly where you are on the chart, trending, ranging, or transitioning. So before you enter any trade, ask, what's the current structure, trend or range? Who's in control, buyers or sellers? Where's the last significant high and low? When you can answer those three questions, you'll always know your tactical position in the market. In the next lesson, we'll move deeper into candlestick basics, how to read individual candles, what they reveal about market psychology, and how to use them to refine your entries and exits.